Today we'll understand how the Black-Scholes-Merton model applies to fixed income securities and how embedded options affect bond pricing. First, let's look at the Black-Scholes-Merton model for fixed income securities. The Black-Scholes-Merton model is one of the most widely used models for pricing options. It works well for many financial assets when we assume that interest rates remain constant and price volatility is stable. However, bonds behave differently from stocks because bonds have fixed coupon payments and a fixed maturity value. Because of these features, applying the standard Black-Scholes-Merton model to bonds requires some adjustments. Next, consider the first limitation of the model when applied to bonds. In the case of stocks, prices can theoretically rise without any upper limit. But bonds are different. The maximum value of a bond is limited because investors will only receive the coupon payments plus the face value at maturity. For example, imagine a bond paying 80 rupees annually for 3 years with a face value of 1,000 rupees. The total possible cash flow from this bond is 80 rupees plus 80 rupees plus 80 rupees plus 1,000 rupees. Since the total payoff is capped, bond prices cannot increase indefinitely like stock prices. The second limitation relates to interest rates. Bond prices are highly sensitive to interest rate changes. The Black-Scholes model assumes that the risk-free interest rate is constant, but in reality, interest rates fluctuate frequently. Bond pricing depends on discounting future cash flows using the prevailing interest rate. As interest rates increase, the present value of future cash flows decreases, causing bond prices to fall. Conversely, when interest rates decline, bond prices rise. The third limitation involves volatility assumptions. The Black-Scholes-Merton model assumes that price volatility remains constant over time. However, bond volatility typically declines as the bond approaches maturity. As time passes, the bond price gradually converges toward its face value because the final repayment becomes more certain. This means long-term bonds generally show higher price volatility compared to bonds that are close to maturity. Now let's move to bonds with embedded options. Many fixed income securities include special features known as embedded options. These options give either the issuer or the investor certain rights that can change the bond's cash flows. The most common types are callable bonds and putable bonds. Because these options alter potential cash flows, they also change the relationship between bond prices and yields. Let's first discuss callable bonds. A callable bond gives the issuer the right to repurchase the bond before maturity at a predetermined call price. Companies usually exercise this option when interest rates fall, allowing them to refinance their debt at lower rates. From a valuation perspective, a callable bond can be thought of as an option-free bond minus the value of the call option. Callback bond price equals option-free bond price minus call option value. Since the call option benefits the issuer, investors require compensation for this risk, which usually means callable bonds trade at lower prices than similar non-callable bonds. Callable bonds also introduce the concept of negative convexity. Under normal circumstances, when yields fall, bond prices increase at an accelerating rate. But with callable bonds, the price increase is limited because investors know the issuer might call the bond. As yields drop significantly, investors begin to expect the bond to be called. This expectation causes the price-yield curve to flatten, creating negative convexity. In other words, price gains become smaller as yields continue to fall. Finally, let's look at putable bonds. A putable bond gives the investor the right to sell the bond back to the issuer at a predetermined price before maturity. Investors are more likely to exercise this option when interest rates rise and bond prices fall. The pricing relationship for a putable bond can be expressed as putable bond price equals option-free bond price plus put option value. Because the put option benefits the investor, putable bonds usually trade at higher prices compared to similar bonds without this feature. The put option also changes the price-yield relationship. When yields rise significantly, the price of a normal bond would fall sharply. However, for a putable bond, the price decline is limited because investors have the option to sell the bond back to the issuer at the predetermined put price. This effectively creates a price floor, making putable bonds less risky for investors in rising interest rate environments. So in summary, while the Black-Scholes-Merton model provides a useful framework for option pricing, bonds require adjustments due to their limited payoff, sensitivity to interest rates, and changing volatility.